Yes, my name is Professor Bret Wells, and I'm at the University of Houston Law Center. Um, I'll give my own views, but any of my views are solely my views and not necessarily the views of the University of Houston or the University of Houston Law Center. You've been listening for an hour, so I want to talk about three discrete things. One, territorial tax regimes, what you should think about as we think about the legislation that is coming forward. Secondly, pass-through entity taxation and business tax reform, what you should think about. And then third, a thought question of will tax reform be only business tax reform? Now, I think everyone here has been saying, and Speaker Ryan yesterday gave a strong shout out for territorial taxation yesterday, and there seems to be a growing consensus that that if we have tax reform, that it will be a territorial tax regime. But what you should consider is that territorial taxation is a double-edged sword. On the one hand, as Greg pointed out, providing a foreign dividends received deduction for distributing foreign earnings from a controlled foreign corporation to the U.S. parent provides competitive neutrality in the outbound context. That's true. But on the other hand, a territorial regime motivates U.S. multinational corporations to find planning techniques to shift their U.S. origin profits to non-U.S. sources so that they're outside of territorial taxation, and motivates U.S. multinationals to engage in planning techniques to say their expenses are U.S. source so that all of their expenses in their global enterprise, or a substantial portion, are within the territorial tax regime. So the gamesmanship inherent in a territorial tax regime is obvious. What you should expect is that there is going to be robust anti-earning stripping base protection measures. So the inbound planning that you do today, I think, is on the table to be rediscussed. I've written and said we ought to have a broad base protecting surtax to eliminate the benefit of related party tax deductible payments, whether they're interest, rents, royalties, to any foreign affiliate. And that's one proposal, but there's a variety of other proposals. But what I think you should believe is that the base erosion profit shifting question is going to be an important question for an essential design of a territorial regime. And that will be the pay for rate reduction. The quid pro quo for a territorial regime, in my view, is going to be that it will actually protect the U.S. taxing jurisdiction's right to tax U.S. origin profits and not have those profits stripped to a low tax jurisdiction. And that will be the pay for business tax reform, in my view. There's a lot of revenue that Congress has, at least on the Senate finance side, believes that base protection is going to be a significant source of revenue. The pass-through entity problem is a significant problem, as David pointed out, and I think Greg pointed out. What do we do with pass-through entities? And I think my point of view is, and I said this in about 20,000 words, what Mark said in one sentence, just don't do anything. If tax rates for C corporations are 25% and individual rates are 39.6%, we are back to the tax rate paradigm in the Jimmy Carter years. And what did we have in that period? We had a large amount of business activity conducted in C corporations, and we had to worry about bailing out earnings and profits at capital gains rates and the rest. But the benefit of having ongoing, immediate lower tax rates on active business income that's invested on a time value of money perspective is going to be significantly better than the double tax. But there's another change in the system today. I think Senator Hatch's dividends paid deduction form of corporate integration that he held hearings on last year is going to be the key to solve the pass-through entity problem. Last year, Senator Hatch proposed that a corporate level dividends paid deduction should be given for all distributed earnings, and that there would be a shareholder withholding tax. Tax-exempt investors hated that idea. They did not like having a shareholder withholding tax. So the alternative that is the same basic idea that is under discussion is that there would be a partial dividends paid deduction of 40%. And that 40% is because about 60% of the investors are tax exempt, so we'll give a deduction for the portion of the shareholders that are taxable. This partial form of corporate integration preserves the amount of shareholders that will be taxable, namely the 40% that is represented by the taxable shareholders would get a deduction, but the 60% of tax-exempt shareholders would not get a deduction. That partial integration approach is actively being considered by the Senate Finance Committee, and they see that as a viable alternative to solve the pass-through entity problem. So what should you think about? Well, let's think through the mechanics. If there's a 25% corporate tax rate and distributed earnings can get a 40% deduction, that provides another 10% deduction for distributed earnings, or 10% benefit. It is no coincidence that that's a 15% rate. And that 15% rate is what the Trump administration has said they wanted, but that corporate integration dividends paid deduction proposal achieves that 15% rate in a way that is significantly less costly from the federal government's perspective, from a revenue perspective. So from my perspective, I think that what is likely to occur is that we're going to have a regime that is a territorial regime. There will be a partial integrated corporate tax regime. And what that means, I think, for you is that I hope you really did a lot of good studying in your corporate tax class. Because the days of wanting to tell your client what is the best structure for you, if you can have a lower subchapter C rate and a deduction for distributed earnings out of the C corporation, that is going to motivate you to tell your clients to take it in their own hands to move from pass-through entities into C corporations. And so I think the pass-through entity problem, like Mark said in one sentence, took me 20,000 words to say it in a law review article, I think it's a tempest in the teapot. If Senator Hatch's proposal is accepted as a partial integration proposal with no withholding tax on any distribution, but just partial deduction at the corporate level. And that would give a 25% tax rate for reinvested earnings, a 15% rate on distributed earnings. Finally, will tax reform only be business tax reform? Speaker Ryan said yesterday he wants comprehensive individual and business tax reform. I just think there's just too much acrimony in Washington for that to happen. I don't see in this caustic political environment that we can achieve individual tax reform. Nor do I think it is possible to have revenue raisers on individuals as the pay for business tax. I don't think that is possible either. I think what is possible in the current caustic environment is the things Greg pointed out. We need business tax reform. I think that's possible if there are pay-fors for the business tax reform. And what is the pay-for going to be? I think it's going to be base protection, earnings stripping, those measures that will prevent the migration of profits from U.S. territorial jurisdiction to offshore jurisdictions. So is there a winner and loser in this? I think the winner will be U.S. businesses will receive a lower rate. I think outbound investment will be competitively neutral. But I think inbound investors that have been accustomed to having a significant portion of their operating profits paid to their foreign affiliates through rents, royalties, interest, and the like, so that the net taxable income in their U.S. affiliate is reduced, that group of individuals or corporations, I think, are going to be disadvantaged. And I think U.S. multinationals will look at a territorial taxation and say, can I achieve the same thing in the inbound context that foreign inbound investors have had? And I think that's what Congress is going to attempt to forestall. Those are my comments.